The conference room was quiet, the only sound the faint hum of a laptop fan and the rhythmic tapping of a pen against a mahogany table. On the screen was a standard 30-page financial plan, color-coded charts, retirement projections, and asset allocation displays that looked identical to a dozen others produced that week. Across the desk, a longtime client adjusted his glasses, looked at the final fee disclosure, and asked a question that had been haunting the practice for 18 months. Why should I pay $800 for this when a robo-advisor can generate the same document for free? The silence that followed was not one of offense, but of realization. Angela Nobert sat in her chair, looking at the glossy pages she had spent 10 hours manually assembling, and understood that the client was technically correct. She was a highly qualified independent financial planner, but she was selling a commodity. She was caught in the commoditization trap, a state where a professional's value is perceived as being equal to the software they use. She was fully booked, working 60 hours a week to serve a roster of middle-income clients, yet her business was flat. The $800 fee was a ceiling she could not break because she was delivering a standardized product that failed to reflect her actual depth of expertise. This is a case study, based on Angela's own account, of how she dismantled that ceiling, not by chasing wealthier clients or spending more on marketing, but by using a proprietary AI strategy to transform the intelligence of her output. This is the story of how she shifted her positioning from an expensive data entry specialist to a financial architect, quadrupling her per-client revenue while reclaiming her professional identity. To understand the shift from $800 to $3,200 per client, one must first look at the invisible friction of the manual financial planning model. Before her transformation, Angela Nobert's professional life was defined by the grueling labor of data synthesis. A typical Tuesday began not with strategic advisory, but with the manual ingestion of client bank statements, tax returns, and brokerage exports. She would spend 4 to 5 hours just cleaning and reconciling data into her planning software, a process she called the clerical tax. By the time she actually sat down to look for the strategic opportunities in a client's financial life, her cognitive energy was already significantly depleted. She was delivering standardized plans, projections that used average market returns and generic inflation assumptions. While technically accurate, these plans lack the granular, behavioral nuance that actually changes a client's trajectory. Angela felt a profound sense of professional dissatisfaction. She knew she was capable of more, but she was trapped in a business model that rewarded volume over depth. At the end of these days, she felt like a professional running an assembly line of documents, constantly racing against the clock to justify her existence to a client base that was increasingly being courted by zero-cost digital platforms. The emotional toll was a state of permanent defensive positioning, where she was constantly having to argue that her human involvement was worth the premium, even when the output did not visibly support that argument. The problem transitioned from a personal frustration to an existential business threat during a quarter where 3 new clients withdrew from their engagement letters, citing the ease of a new automated wealth platform. Angela sat in her office, reviewing her revenue projections, and realized her income was flat despite her workload being at an all-time high. The threat was not just competition, it was the erosion of her perceived authority. If her output looked like a machine's output, she would eventually be priced like a machine. The consequence of her manual process was a lack of strategic headroom. Because it took her so long to produce a basic plan, she never had the time to perform the deep scenario modeling that actually identifies hidden risks or tax efficiencies. She was providing a snapshot of the present but not a map for the future. She reached a point where she understood that she had to stop being the person who aggregates data and start being the person who interprets intelligence. She needed a way to provide a level of personalization so deep and so data-backed that the comparison to a robo-advisor would become fundamentally irrelevant. She realized that the only way to command a premium was to deliver one, and that meant automating the clerical tax entirely so she could focus on the architectural nuance that no algorithm could replicate. The discovery of a new model began when Angela stopped looking for better planning software and started looking for a unified intelligence stack. She spent a month of her own time building a workflow designed to function as a high-speed analytical laboratory. Her first breakthrough was an AI-driven client financial data analysis and pattern recognition. Instead of manually cleaning bank statements, she implemented a protocol that utilized specialized models to ingest 3 years of a client's raw financial history, identifying subtle behavioral spending patterns and hidden cash flow leaks that a standard spreadsheet would miss entirely. The system did not just show what the client spent. It identified the behavioral friction points where their money was drifting away from their stated goals without their awareness. She then integrated personalized scenario modeling and stress testing that went far beyond the standard projection. She built a framework that allowed her to run hundreds of iterations of a client's plan against specific localized economic risks, including a downturn in their particular industry or a regional real estate correction. The first time she ran this on a client file, it revealed that their supposedly safe retirement plan carried a 40% failure rate in a high inflation scenario that her previous software had never considered. The trial and error process was rigorous. She had to learn how to translate complex AI outputs into what she called plain language financial narratives, reports that told a human story about the data rather than presenting a wall of numbers that only she could interpret. The transformation of Angela's practice took hold when she extended the AI into the monitoring and alerting layers of her business. She developed an automated portfolio monitoring system that did not just track price changes, but tracked the strategic alignment of every client's assets against their stated goals and behavioral profile. If a client's risk tolerance appeared to shift based on patterns the AI identified in their financial behavior, Angela would receive a proactive alert before the client even realized there was a problem. This shifted her from a reactive professional who answers questions to a proactive advisor who anticipates needs before they become crises. A specific human turning point came during a review with a couple who had been with her for 5 years. They were planning to retire in 18 months and felt confident in their existing plan. Angela presented her new stress test, which revealed a critical gap. If the husband's industry-specific pension was adjusted for a high-probability legislative change, she says the AI had flagged in recent regulatory filings, their retirement income would drop by 22%. It was a risk that no bank associate and no algorithm would have surfaced on its own. The couple sat in silence for a moment, the weight of the discovery settling in. They did not ask about the fee. They asked how soon they could implement the new strategy. They upgraded to her premium service tier at $3,200 without hesitation. They were not paying for a plan. They were paying for the intelligence that protected their future. The results of this repositioning were a radical shift in both the economics and the quality of Angela's practice. Within 1 year, she successfully transitioned 60% of her client base to the new high-intelligence service model. Her per-client revenue quadrupled, but because her administrative overhead had been collapsed by the AI stack, Angela says her net profit margins more than tripled. Her weeks, which once consisted of frantic data entry and document assembly, were now spent on high-level advisory and behavioral coaching. A typical Tuesday now begins with a review of the intelligence brief generated by her system overnight, which summarizes market shifts and flags the clients who need a proactive outreach that day. She spends her mornings on deep work, crafting the complex strategic frameworks that her AI helps her validate with data, and her afternoons on the human side of the practice. She is no longer a person who sells a plan. She is a person who sells financial clarity. She has successfully decoupled her income from the document and attached it to the insight, moving into a position where her earnings are a reflection of the security she provides rather than the hours she bills. The lessons from Angela 𝐁𝐁𝐁𝐿bert's transformation come down to 3 hard truths. First, the standardized financial plan is now a free commodity. If your deliverable looks like a machine's output, you will eventually be priced like a machine. Second, the professionals who will command a premium in the 2026 economy are not the ones who provide information, but the ones who provide foresight, surfacing the risks a client did not even know existed. And third, the fastest way to test your own value is a single question. Could your client get your deliverables somewhere else for free? If the answer is yes, your fee is at risk. If the answer is no, you are almost certainly undercharging. We want to hear from you in the comments. What is the one part of your process that feels most like a clerical tax? And what would your practice look like if you spend zero time on data entry and all of your time on strategy? And to see the specific stress testing frameworks and behavioral profiling protocols Angela used to reposition her practice, watch our next video on the automated financial planning stack.